This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh. In today's video, I'll be sharing with you 5 stocks that I recently bought during this market dip. Now, this obviously comes at a time where the stock market is crashing quite heavily, and there's a whole bunch of other YouTubers out there saying that you should sell your stocks because the market dip is only going to get worse. However, I do have a long-term horizon. I have 5+ years of staying power in the market. So what that means is that I can buy during high times of volatility, even though the stock prices might come down below my buy price, which a lot of the stocks that I recently bought has actually come down since. So in this video, I'll be sharing with you 5 stocks that I bought during this dip. Obviously, I can't cover them in too much detail because there's 5 and we only have about 15 minutes in a video. So if you do want more detail, let me know in the comment section down below and I can make a dedicated video on that. Obviously, none of this is financial advice and not a recommendation for you to buy, hold, or sell any of these stocks. If you're interested in buying US stocks, be sure to check out Interactive Brokers because they offer one of the best ranges for stocks as well as the lowest commissions. So I have a link down below, check that out. Now with that out of the way, let's get started into the first stock of what I recently bought, and that is Block Inc. Stock ticker SQ. Now this company used to be called Square and it is a relatively large cap company. It's a $59 billion company, and as of this morning, I'm recording this on, it's dropped even more from that $100 mark. So every day it could go up or down 6%. It's very volatile. It makes for good buying if you like volatility. Now the two ecosystems that the company owns, Square and Cash App. Square is a merchant aggregator. It allows sellers to accept card payments through their hardware and software solutions. The Square ecosystem provides more than 30 distinct products and services to sellers that help them grow and manage their business, such as customer relationship management, payroll, business banking, and so on. The company also owns Cash App, which allows users to send, spend, store, and invest money, allowing users to buy stocks and Bitcoin as well. In 2021, it was the #1 finance app across iOS and Google Play in the US, and they have about 44 million monthly transacting users across the US and Europe. Now, they also recently completed their acquisition of Afterpay. Afterpay is an Australian buy now, pay later company, and it basically allows people to pay their purchase in a few different installments. So the reason why they recently acquired Afterpay is because together Square and Afterpay intend to enable sellers of all sizes to offer buy now, pay later at checkout. Give Afterpay consumers the ability to manage their installment payments directly in Cash App, and give Cash App customers the ability to discover sellers and buy now, pay later offers directly within the app. So essentially, the Afterpay acquisition will strengthen both ecosystems. It will drive users of buy now, pay later on Afterpay to the Cash App, essentially increasing the engagement, potentially turning into more revenues for Cash App, and as well as that, it will drive marketing to Square sellers, improving the value proposition of Square to sellers out there. It'll also increase their sales, and so it'll basically strengthen both sides of the ecosystem, and it makes a lot of sense for why Square recently acquired Afterpay. Because there's a lot of synergies involved here. Now, if we look at their revenues, they've basically grown their revenues at a compounded annual growth rate of 55%, and the cost of revenues has grown even more by 61 CAGR. So if you look at what comprises the revenue in 2021, most of that involves the Bitcoin revenue, and as well as that, more than half is related to Bitcoin costs on the cost of revenue side of things. Now, if you understand how they make money on Bitcoin, this actually isn't too much of a concern. Square operates on a commission basis, so they make about 2% gross margin on their Bitcoin volumes. Because of accounting, it distorts that number a little bit because they are required to report the revenue and the cost of revenue fully instead of just the gross commission. However, over here, what I've done is I've taken out the Bitcoin revenues and cost of revenues to calculate the other businesses' gross margin and operating margin, and you can see that the business is trending in the right direction. So in March 2015, the gross margin was just under 30%, and today in November 2021, it's around 55.7%. So we've seen a huge improvement in gross margin. Likewise, we see the operating margin increase from a loss of 18.5% to a break even over the past 4 quarters. Square is growing revenue significantly. The operating margin is expanding as well, and going forward in the next few years, I expect them to make a decent amount of profit given that revenue is still growing at a very quick pace. And in terms of the future growth, they do operate in a market that has a huge TAM. They have $100 billion opportunity with multiple vectors for future growth. If you look at the Cash App ecosystem, that represents a 60 billion revenue opportunity in the US. And Square is still a business that generates a lot of their profit inside of the US. So as you can see over here, the gross profit in markets outside of the US is only 9% of Square's gross profit. So there's still a lot of room for this company to grow overseas. It is a high risk, high reward type company, but I think with the valuations coming down from, about $280 to below 100, I think a lot of the risk has already been priced in, and I've recently bought a small stake in Square or Block Inc. The next stock that I recently bought is Meta Platforms. The stock is down 44% year to date, and I've made a video on Meta Platforms. You can check it out over here. That's a very detailed thesis on why I recently bought that. However, just to give you a very brief summary, Meta Platforms owns a family of apps which have in total 3.59 billion people on them. So this is 56% of the total world population, excluding China, which doesn't allow these Meta apps to operate in. Now, if we look at the average revenue per user, or the ARPU, that has also increased quite well from $10.14 in Q4 of 2020 to $11.57 in Q4 of 2021. Most of the growth coming from Meta will be from the growth in ARPU rather than the monthly active people, just because they've already got more than half of the total world population on their platforms. So it's very hard for them to increase this number, but most of the growth will come from here. And also from share buybacks, because as you know, they trade on very undemanding valuations. They have a very high cash balance on their balance sheet at $33.5 billion, or 6.4% of the current market cap. They trade at a free cash flow yield of 5% even after an estimated $30 billion in capex. They can still pay a 5% dividend if they wanted to. So this is a company that basically spits out a lot of money. It prints money. It trades on a super low valuation at around 15 times. So the market is currently not ascribing any growth to Meta Platforms, which is why I've recently bought more shares in Meta. Now, the third stock that I recently bought is a little bit of a controversial one. This is Tesla, stock ticker TSLA. I'm sure you all know this is an electric vehicle car manufacturer, and this is actually not the first time that I used to own Tesla. I first bought Tesla in May 2019 when the share price was about $200 per share pre-split. So they did split 1 to 5. So equivalent to a post-split price, that would be about $40 per share. I later then sold Tesla at about 900 pre-split, which is about $180 today. So that was actually one of the worst financial mistakes that I've made throughout my investing journey. So the two questions that I had at the time when I did sell it though was whether they can manufacture cars profitably and whether they have the ability to scale. And the recent results did show that they are able to achieve both things. As you can see over here, the total production has grown by 83% year on year to 930,000 from previously 509,000 total units. I can see very clearly that they have the ability to ramp up production, and with the pipeline of new factories coming up with Austin and Berlin, that does secure a lot of the future growth in production. And you can see the demand for Tesla cars have been through the roof. Basically, they have only 6 days of supply in their vehicle inventory. If you look at the future outlook for volume production, over a multi-year horizon, they expect to achieve 50% average annual growth in vehicle deliveries. They also mentioned that their factories have been running below capacity for several quarters as supply chain became the main limiting factor, which is likely to continue through to 2022. So despite this huge growth at 83%, they were not running at full capacity. And so that's why I think it's very easy for them to actually achieve that 50% growth. If they were to, reach closer to their capacity in terms of production. They've also been making a few cars in Texas and Berlin, which is not fully ramped up yet. So as I said, that will drive a lot of the future volume growth there. And Elon Musk has said that the supply chain will be the fundamental limiter of output across all factories. So the chip shortage, while better than last year, is still an issue. And we do expect, even with all those issues, significant growth in 2022 over 2021, comfortably above 50% growth in 2022. So we can see vehicle growth ramping up. And most recently, the GAAP operating margins also show that Tesla is ahead of the traditional automakers as well. So this pretty much answered my two questions, whether they do have the ability to scale and whether they have the ability to make cars profitably with a net income margin right now 14.19%. Now, if we look at the future growth, the average consensus analyst forecast for 2022 is $10.54. So currently, Tesla trades at a PE below 80 times. In the short term, there will be cost inflation, so this might impact the operating margins in the short term, but over the long term, this company is trending in the right way. Because of the recent dip, I've taken that opportunity to buy back into Tesla stock. Now, the fourth stock that I recently bought is Google, another company that needs no introduction. They are down 10.43% year to date. They are the largest search engine market worldwide. They own 92% of the market share. The second largest player is Bing, which owns roughly 3% market share, and the 3% of Bing, I think, is people clicking onto their browser, and on default Bing comes up because it comes with Microsoft. So on a percentage basis, maybe Google is a bit higher at around 95%. They also are the largest net ad revenue advertiser by market share. Google owns about 28% of the market, whereas Facebook, the second largest player, owns 24.5% of that market. So Google also owns Android, which is the largest mobile operating system. They have about a 70% market share. They are number 2 in email clients, Gmail at 26%, and they are the third in Google Cloud at 10% market share. Diluted earnings per share has increased from $58.61 to $112.20. So that's almost a double. They have a rock solid balance sheet. They can use that cash to pay off all their long-term and short-term liabilities. And if you look at their cash flow statement, they generated a free cash flow yield of $64 billion. That's calculated by taking the $91.6 billion from operating activities minus the purchase of property and equipment, as well as purchases of intangible assets. That gives us a free cash flow yield of 3.7%. They bought back $50 billion worth of shares in 2021, and in 2020 they bought back $31 billion worth of shares. So these are very good capital allocation moves by management, given that they did generate a huge chunk of free cash flow. And if you look at the current valuation right now, it's trading at reasonable valuations at a forward PE of 22.38 times, and that's well below the mean of 26.73 times. So for a high quality company like Google that still has a lot of growth ahead of it, I think that's a reasonable buy, which is why I've recently added Google into my portfolio. Now, the fifth stock that I recently bought is a New Zealand company, and that is Somerset Group Holdings Limited. They are down about 27.05% from its highs. Somerset is an aged care and retirement village operator. They own villages around New Zealand, and the one in Ellerslie in Auckland is one of the most bougie ones, the most premium ones. And you can see that this lake over here, when I visited back in 2018, this lake was completely empty. They just dug a hole, and it's good to see that this is now fully built and looks very, very premium. Now, Somerset did report their full year results at the end of February, reporting a very strong result. They reported a $141.1 million full year underlying profit, and that is up 44% year on year. At a market cap of $2.6 billion today, that means that they are trading at a trailing PE of about 18.5 times. So 18.5 times for a company that has one of the best growth track records, that is a pretty good value in my opinion. So why am I buying now? Well, in my opinion, as I said, the valuation is reasonable. It already prices in some of the property headwinds that we expect to see in New Zealand, with property prices now starting to slow down and some of them even dipping. And secondly, Oceania is my largest position. Oceania is also another aged care and retirement village operator. So I don't want to take any more idiosyncratic risk, but I like the industry. The industry has been trending down. It's going on discount recently, so I want to take that opportunity to buy more into that industry without taking more idiosyncratic risk or company-specific risk in Oceania Healthcare. And thirdly, they have a lot of good growth ahead of it. They've signaled that they'll increase their build rate to 600 units, and they have the largest pipeline of units in New Zealand. So Somerset has the development gene in them. Compared to all the other developers, Somerset has the best development track record, in my opinion. So I think they'll have a lot of growth ahead of it with how much they have already in their pipeline, already planned to be built over the next 5 years. So that's the reason why I've been buying Somerset as my fifth stock recently. So let me know what you think about the stocks I recently bought in this list, and comment down below as well what stocks that you've recently been buying. Always be keen to hear your thoughts. But that's all for today's video. Thank you guys for watching. Until next time, take care.